In this short lesson, I want to explain a little bit more about how you assess inherent risk. As we learned in the previous lesson, inherent risk accounts for 1/3 of the audit risk model, yet it probably has the least amount of evidence available, meaning that it requires the most professional judgment. Let's quickly identify the major factors that an auditor should consider when assessing inherent risk. First, we need to consider the nature of the client's business. The more susceptible the client is to changes in the competitive marketplace, the higher the risk. For example, think about a technology business. The business depends on constantly improving technology to remain competitive, and the product life cycles are very short. Consider how fast research in motion has fallen victim to Apple. Second, look at the nature of the client's data processing systems. The more poorly the IT system is managed and maintained, the greater the inherent risk. Complexity and sloppy management practices always raise inherent risk. Next, evaluate management integrity. Lacking integrity has been a significant driver of lawsuits against auditors in hindsight. Next, consider the client's motivations. These have a pervasive impact on the policy selection and the accounting application. Such things as earnings-based bonus plans, financially calculated lending covenants, desires by management to sell or go public, tax minimization schemes are all examples that can lead to management bias and consequently increase inherent risk. Next, consider the results of previous audits. Weaknesses in prior years often recur and continue to exist because they are systematic in nature and clients are slow to make changes. A higher inherent risk in last year may lead to a higher inherent risk this year. New engagements are by their nature more risky as the auditors lack familiarity with the client and their business. So for new clients, inherent risk is often higher. When we have related party transactions, inherent risk increases because often it is more difficult to evaluate whether the terms of such arrangements represent fair value. And also, non-routine transactions bring with them greater inherent risks as the clients often lack the experience in recording and reporting such transactions. Highly judgmental accounting estimates increase inherent risk. For example, lawsuit contingencies, allowances, warranty provisions, and impairment calculations. The more of these sorts of accounts the client has, the greater the inherent risk. Also, consider the assets that are highly susceptible to misappropriation or fraud, such as cash and inventory. These sorts of assets lead to a higher inherent risk assessment. So as you can see, there are a lot of different considerations to take into account when you assess inherent risk for each cycle, each account, and each audit objective. Some of the factors we just discussed may affect many or perhaps all of the cycles, such as management integrity. Other considerations are account specific. Think of cash, which can be easily stolen or diverted and would only result in a higher inherent risk assessment for this account. Remember that inherent risk is not static. It's assessed during the planning stage, but it could be possibly reassessed during the audit if new information comes to light with respect to any of those factors that we just discussed. That's it for now, so until next time, don't stop till you get to the top. When you get to the top, don't stop.